This is ShadowQuant, Stocks, brought to you by AresLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Thursday, August 27, 2026, and this is the After Hours session. Now, let's get into it. The market is splitting down the middle. While AI leaders and industrial stocks push higher, healthcare and retail names are getting crushed by sticky inflation and a flat yield curve. We are looking at a market that is range-bound in the index, but violently divergent in the sector rotation. Let's get into the data. On the calendar today, we have ADSC, AFM, and ALAR reporting. Of those, ADSC is the one to watch for software sector positioning, with estimates at $2.35 per share. The rest of the focus today is on the broader market structure and the earnings reactions we saw overnight. Here is the snapshot. SPY is sitting at $766.08, up just 2 cents. QQQ is at $711.37, slightly positive. But look at the breadth. Diamonds is down $0.19%, IWM is down $0.10%, and the healthcare sector is leading the laggards at -1%. The 10-year Treasury yield is holding at 4.66%, and that number is driving everything we are about to discuss. Let's start with the headlines moving the needle. CRM is gapping up nearly 10% to $225.89 after Needham reiterated the stock and maintained its price target at $400. NVDA is up 6.3% to $222.82 on a Raymond James upgrade that raised the target to $515. And in retail, BBY is down 7.2% to $81.12 despite raising guidance, while DG is up 7.6% on a beat.
Those CRM and NVDA moves are not just upgrades. They are institutional confirmations that the AI capex cycle is intact. When Raymond James and Needham are moving the needle on targets this aggressively, it tells us big money is willing to pay premium multiples for infrastructure exposure right now.
And that is exactly where the risk lies, CIPHER. You are looking at the price targets and seeing conviction. I am looking at the 4.66% yield and seeing a valuation bubble. You are pricing in a soft landing while the Fed funds rate is sitting at 3.63% and inflation is stuck at 3.3%. Those AI names are trading on future growth that a higher for longer rate environment actively discounts.
That tension between growth conviction and rate sensitivity is the core of today's session. Let's dig into the technical structure of the major indices. Let's start with SPY. It is at $766.08, up 2 cents today. Grid, where are we on the chart?
SPY is trapped in a very tight, compressed range. It is currently sitting between $763.93, which was yesterday's low, and $767.35, yesterday's high. The price action right now is indecisive. It is resting just below resistance and above support, showing absolutely zero momentum. It is consolidating, not breaking out.
Pulse, what is the sentiment reading inside that range?
The sentiment inside that range is complacent. The VIX is down another point, sitting at 15.45, which is near its 5-day low of 14.77. The market is pricing instability, but that is masking the fact that capital is actively fleeing rate-sensitive sectors. You have broad sentiment that is neutral to bearish, but the VIX is telling you nothing about the structural weakness in the consumer and healthcare sectors.
SPECTER, does that low VIX give you comfort?
It gives me alarm. A VIX of 15.45 while the 10-year yield is at 4.66%, and the yield curve is flat with a spread of just 0.47% is a classic sign of underpricing risk. The market is ignoring the fact that real GDP growth has slowed to 1.48%. That low volatility is not safety. It is a lagging indicator of a market that hasn't realized it is running into a wall.
Moving on to QQQ, it is at $711.37, up 9 cents. Grid, what do you see here?
Triple Q is showing relative resilience compared to the broader index, but it is facing immediate overhead pressure. It is trading only 3.4 points above its August 26th low of $707.97, and it is well below its 10-day high of $734.58. The technical setup here is heavily concentrated in mega-cap tech strength. The rest of the index is holding it up. If SPY breaks that $763.93 support level we just discussed, Triple Q is likely to test that $707.97 low very quickly.
And that technical pressure on Triple Q is being driven by fundamental divergence. The strength is entirely in AI capex names. NVDA and CRM are driving the green, but the rest of the index is being punished. You are seeing a bifurcation where only companies with clear AI visibility are commanding premium multiples, while everything else is getting sold off.
Pulse, how is the crowd reacting to that divergence?
The crowd is split. News sentiment for NVDA is overwhelmingly bullish at plus 0.57, and for Amazon, it is plus 0.71. But look at the broader market. SPY is range-bound at $766.08, and IWM is consolidating near its 10-day low of $297.04. The bullish sentiment is not lifting the boat. It is just buoying 2 or 3 ships while the rest sink.
Let's talk about the laggards. The healthcare sector, healthcare, is down 1% today and down 1.22% this week. SPECTER, you mentioned rate sensitivity earlier. What is happening here?
Healthcare is getting crushed by the 4.66% 10-year yield. This sector is highly sensitive to interest rates, and with the Fed funds rate holding at 3.63% and CPI stuck at 3.3%, there is no relief coming. The market is pricing in a higher for longer environment, and healthcare valuations are collapsing under that pressure. The flat yield curve spread of 0.47% is a historical precursor to growth slowdowns, and the healthcare sector is the first casualty.
Pulse, is there any sentiment shift in healthcare right now?
There is a complete lack of conviction. While tech sentiment is hot, healthcare sentiment is cold. The VIX is low, but that is not because investors are happy with healthcare. It is because they are ignoring it. The market is rotating capital out of rate-sensitive growth and into high-yield beneficiaries. You are seeing a structural shift, not a temporary dip.
CIPHER, is there any fundamental support for healthcare at these levels?
No, the fundamentals are being overridden by the macro environment. In a 4.66% yield environment, high multiple growth stocks like healthcare are facing severe multiple compression. The data shows a flight to sectors that can pass through higher financing costs or benefit from the current yield curve dynamics. Healthcare has neither, so the selling is fundamental, not technical.
Now let's look at consumer discretionary. It is down 0.67% today and down 1.21% this week. The earnings reaction in retail was brutal. BBY dropped 7.2% despite raising guidance. DG, on the other hand, beat and rose 7.6%. CIPHER, what is driving this split?
This is the sell the news dynamic in action, and it is exposing fragility in consumer spending. BBY raised guidance but still got punished, which tells us the market is pricing in future guidance misses or macro headwinds that will crush retail margins. DG, however, has defensive pricing power. In this yield environment, the market is only rewarding companies that can maintain margins despite sticky inflation. BBY is being punished for lacking that power.
Pulse, how is the crowd viewing this retail weakness?
The crowd is losing faith in the consumer. The gap down in BBY despite a beat is a massive red flag. It signals that consumer confidence is fragile and that guidance fears are overriding positive fundamentals. The sentiment data shows that retail names are being treated as risk-offs. The market is saying, we don't believe the guidance, and we don't believe the consumer can handle these rates.
And that is the danger signal. You have a sell the news dynamic in retail, a flattening yield curve, and slowing GDP growth. The market is bifurcating into a narrow AI bubble while the rest of the equity universe faces increasing pressure. Small caps like IWM are consolidating near their 10-day low of $297.04, underperforming large caps. This is not a healthy market. It is a fragile one.
Let's look at industrials, the industrial sector. It is up 1.9% today and up 2.19% this week. Grid, why are industrials leading?
Industrials are outperforming because they are benefiting from the defensive rotation. While growth and healthcare are being sold, capital is flowing into sectors that are less sensitive to rate cuts and more aligned with current economic realities. Technically, the industrial sector is showing relative strength, holding its ground while the broader market consolidates. It is a classic flight to quality move within the equity universe.
SPECTER, is there a risk to this industrial strength?
The risk is that this strength is an illusion. It is a defensive rotation into a flattening yield curve environment. But if the 10-year yield spikes further, or if GDP growth decelerates below 1.48%, industrials will not be immune. The flat yield curve spread of 0.47% is a caution signal for economic growth, and industrials are directly tied to that growth. This is not a sustainable leadership pattern if the macro backdrop deteriorates.
Apex, bring it together. Grid, Pulse, CIPHER, SPECTER, what is the structural read?
The market is in a state of high yield versus growth tension. Grid flagged the compressed range in SPY and the resistance at $767.35, which shows the broader index is stuck. But CIPHER showed us that the fundamentals are bifurcated. AI CAPEX names like NVDA and CRM are commanding premium multiples due to institutional conviction, while rate-sensitive sectors like healthcare and retail are facing multiple compression. Pulse highlighted the sentiment disconnect, where a low VIX of 15.45 is masking severe weakness in consumer and healthcare sentiment. And SPECTER correctly identified the risk. The flat yield curve and sticky inflation are actively punishing high multiple stocks. The data shows a market that is range-bound on the surface, but structurally divergent underneath.
So the takeaway is clear. The index is stagnant, but the sector rotation is violent. AI and industrials are leading, while healthcare and retail are lagging. The VIX is low, but the macro risks are high. Keep your eyes on the 10-year yield and the 4.66% level, and watch for any breaks in the SPY support at $763.93. That is the data for today. This is ShadowQuant Equities Edition. This is AI-generated content for informational purposes only, not financial advice. That wraps up this edition of ShadowQuant Equities. Stay tuned for the Tokyo session, where we will see how these calls play out. Until then, trade safe.